Welcome to this video. Today we're going to talk about Beyond Meat, and it's now trading at 96 cents, and it has collapsed a lot in the last few weeks because they had a lot of negative news and there was a lot of dilution going on. So could this be the last chance to buy more Beyond Meat, or is this the end? In this deep dive stock analysis video, we're going to find the truth. So buckle up and let's dive right in. The market just opened and we can see here on the charts that Beyond Meat is trading at 98 cents. And it's looking a little bit bullish so far during the market open. And you can see that I put the conversion price here at $1.75. This is the price where the creditors can convert their notes into shares. There's a reason why they put this value there, and these creditors, these big money managers, they really believe that there is value in the company, or else they will not do it. And that gives me the confidence that I think that buying below this conversion price will give a sort of margin of safety. We can see here that a month ago or something, there was this massive short squeeze and then collapse. Maybe we're going to make a double bottom before we go right up, but I'm still optimistic and I think that this December can still be looking really good for this company. For the people who don't know yet, Beyond Meat is in the plant-based meat market, and they make plant-based foods and they mimic meat like sausages or burgers like we can see here, and it's all based on plants. So the most recent news was actually very bearish, and that's why the price is still pretty low and under $1, is because here we can read Beyond Meat fined nearly $40 million over Philadelphia trademark infringement. The California-based alternative meat supplier has been fined $38.9 million for violating a Philadelphia trademark. And this is a big chunk of money if you put in perspective that in the last quarter they only had a revenue of 70 million. So 40 million is a lot of money for this company. And that is a little bit of a setback and a little bit of bad luck. We can see here that the expected growth rate for the plant-based meat market is around 19.4% from 2024 to 2030. That's the expected growth rate. That's a huge growth rate, and Beyond Meat is positioned well in this industry. So it's possible for them to be profitable if they turn around the company, reduce the cost of goods sold, and if they increase the margins, then they can actually become profitable, and that could increase the stock price tremendously. And we can see here that the problem is that they have a lot of competition, like Impossible Foods, Corn Foods, Morningstar Farms. Beyond Meat is one of the most popular meme stocks at the moment, and that could help this stock surge higher in the near future. And that's great. And we can see that most people are still very bullish, and that's great. We can see here that the sentiment is still bearish because the price is so low and it has crashed down a lot. But we can see that the participation ratio is extremely high, and this measures the number of unique accounts posting on the stream relative to the number of total messages on that stream. Beyond Meat is not profitable at the moment. Their netcom is negative, and that's why we always look at the price to sales ratio, whether it's still undervalued and cheap at the moment. So here we can read the price to sales ratio also helps new companies or startups with zero net income place a valuation on their assets. A low price to sales ratio is considered optimal, but we also have to look at the competition and whether to really know whether it's cheap or expensive. And here we can see the formula. Price to sales ratio is share price divided by total sales, which is revenue. So the price to sales ratio is essentially the market cap divided by its revenue. So if the stock price collapses, then the market cap will go down and the price to sales ratio will be lower, which means more cheap compared to its revenue. So here we can see that the price to sales ratio is at 1.5, which is average. I would say it's fair value based on this ratio. The big question is, could there be a second wave short squeeze? And could this price spike much higher like it did a month ago? Well, here we can see that the short percentage of float is now 20%, which is actually pretty significant, but not as much as it was before the recent short squeeze when it went from 50 cents to $7. And we can see it takes 0.7 days to cover, which is not too long of a time. So based on this statistic at the moment, I would say a massive short squeeze I'm not expecting, but maybe a small one. And if we look here we can see the data, and we can see that before this massive short squeeze, when it went from 50 cents to $7, we can see that the percentage of short float was 63%, which was massive. And the days to cover was 8 days. So it took the shorts 8 days to cover to buy everything back. And that's why there was this massive short squeeze. And right now we are on 20%, which is still pretty high in my opinion, but not as high as it was before. An economic moat refers to the competitive advantage a company has towards its competition. And here we can find whether it has a strong, wide economic moat. So if we press Beyond Meat, we can see that it doesn't really have a strong moat because it's like a meme stock. It's in a turnaround phase. They just cleared their balance sheet and they got rid of their debt and they diluted the shares. And it doesn't really have a moat. It has a moat score of 3 out of 10. Here we can read Beyond Meat has brand recognition in the plant-based meat market, but lacks meaningful cost or distribution advantages, competition, low switching cost, and weak profitability, limited moat strength. And we can see here that the strength are a strong early mover brand in plant-based meats. A lot of people have heard of Beyond Meat. They do partnership with major retailers and food chains. For example, they do partnership with Walmart and with Hard Rock Cafe recently. And they are rising consumer interest in health and sustainability, product innovation, and R&D capability. But there are a lot of risks too, because there's a wide competition from traditional and alternative protein producers. A lot of private companies like Impossible Foods take a lot of market share away from Beyond Meat. There's low switching costs for consumers and retailer, weak economies of scale and thin margins, and declining demand and brand fatigue in certain key markets. I'm very bullish on Beyond Meat, but it is a meme stock. It is a high risk, high reward company. And that's why I only allocate a certain percentage of my portfolio. I only allocate a maximum of 4% of my portfolio at the moment. And so if Beyond Meat goes to zero, I lose 4%, but the upside is still unlimited and it can boost my portfolio if it goes all the way back or a next short squeeze is going to happen. So it's always important when you invest in these type of companies that you avoid these 3 mistakes. And the first one is to not use leverage. Don't borrow money from brokers to invest. The volatility is insane in these companies and you do not need extra leverage because you're competing with someone who only allocate a small percentage to this stock and he has a much higher tolerance to volatility. And if you go all in, you become emotional and you sell at the worst time. And you also have a risk of a margin call. The second rule is don't break your allocation rules by wide margins, which refers to the first rule. It kind of means that if you say I only allocate 4%, then don't go over the 4% because it's sometimes alluring to buy more and more and more once it goes lower and lower and lower. But at a certain time, you have to be like, hey, I already allocated 4%, it's fine. So the third mistake to avoid is do not fall in love with one business or stock. It's very risky to do that because you can never be 100% sure, even though you have a bullish outlook of the company. So in short, I think that Beyond Meat is a high risk, high reward company. And if we allocate a certain percentage only to our portfolio, then this company becomes a low risk, high reward company because we can only maximum lose the allocation, but the upside is still unlimited. If we look here at stockanalysis.com, the analysts think that in the 12-month forecast, it will not go lower than 0.8 cents. That's the worst case scenario according to them. And the highest, most optimistic case is $4. And this is the average, and that's based on these forecasts. And if we look here on the trading view, we can see basically the same story. They think that the worst case scenario in the 1-year forecast is 80 cents, which kind of shows that we are close to the bottom because it was at around 90 cents before. And I also believe that below 80 cents is unlikely, but maybe a double bottom. So I would say worst case scenario like 50 cents. So we're back on the charts again and we see that the price has gone up a little bit. It's now over $1. It's $1.01. And I put here an orange line at my average cost price. So it's around $1.68, $1.70. And you can see that I'm down around 40%, which is okay. I'm still very bullish and I think that the stock will climb higher in the future. I think we can go all the way up if there's enough hype this December. I will hold this stock for like a few years and see if this company can turn around. If they can become even profitable again, then the intrinsic value will be much higher. And then we can see the $5, $7, $8, or even $10 range in the near future. But of course, nothing is guaranteed. Always do your own research. If you like this kind of content, feel free to like and subscribe. And I'll see you in the next video.